What's going on, everybody? Good afternoon. This is Trading G's with G. Today is episode 4 of my free trading tips series. This one's going to be titled Tax Loss Harvesting. If you guys watched episode 3, it was on the wash sale rule, and these two I feel like really connect. Literally, they're hand in hand. I'm going to get into all that. I gotta say thank you for everybody that's been rocking with me and subscribing. I believe somebody liked episode 2 and actually subscribed to my channel. So shout out to you. If you're still watching, welcome back. So tax loss harvesting, this is something that a lot of investors, a lot of traders really need to know. I'm just gonna get down into it. So tax loss harvesting is selling securities at a loss to offset the amount of capital gains tax owed on other investments. This is something that a lot of people like to do towards the end of a year. Why? Because people do not want to pay a lot of taxes. I don't think anybody wants to owe Uncle Sam plenty of money. You have to know really how much money you're making on the year with a certain stock or ETF or options trading. You have to pretty much combine all your income on a specific brokerage and tally down like I do. I rather just write myself on the pad. But it's always good to also get knowledge and learn how to read your 1099s because everything will be on there. You receive them every single year, obviously, if you have a brokerage. So this strategy is commonly used to limit short-term capital gains commonly taxed at a higher rate than long-term capital gains to preserve the value of the investor's portfolio while reducing taxes. So short-term capital gains is something that is less than a year. So if you hold Nvidia stock, for example, and you make a profit on it, it's short-term capital gains if you sell Nvidia within under a year of the day you purchased it. And it'll be considered a long-term capital gain if you've held that stock for a year and a day and beyond, which will obviously be less taxes you will have to pay on that investment. But let's get down into it. So like I was saying earlier, most investors use this strategy at the end of the year when they access the annual performance of the portfolios and it impacts their taxes. It is a tool for reducing overall taxes. I'm going to go over the example shortly, but you see how it ties in with the wash sale rule. So not to sound repetitive from episode 3, but it has to be said. You cannot take advantage of tax loss harvesting with any asset unless you respect this wash sale rule. This is a rule you do not want to break if you want to take advantage of tax loss harvesting, because you will not be able to write off any of your losses if you violate the wash sale rule. Watch episode 3 and I specifically explained what that is. So, an example of tax loss harvesting. Right here you have a portfolio, mutual fund A. This person had $250,000 in gains, held for 450 days. This will be a long-term capital gain if sold. Fund B, $130,000. This is a loss, held for 635 days. Mutual Fund C, $100K. Another unrealized loss, held for 135 days. Sorry, this would be a gain, unrealized gain. So all these are sold, right? Trading activity, still with me. So mutual fund E sold a gain of 200,000, held for 380 days. That's over a year, right? 365 days, 15 days over a year for Fund E. Mutual Fund F sold a realized gain of 150,000, was held for 150 days, so that's a short-term capital gain, right? In total, 200,000 plus 150,000 is 350,000. Are you with me? Okay, so down here it explains the tax owed from these sales. So the tax without harvesting, you have 200,000 times 20%, and you have 150,000 times 37%. So let me go over here real quick to the tax bracket. So this is where they are getting this 22% and this 37% from. You have to realize if you're single, the tax rates are different. If you're married, they're not the same tax rates. You will not be in the same tax bracket. So that is where they get the math for 200K times 20% and 150K times 37%. If the investor harvested losses by selling mutual funds B and C, which are right above here, the sales would help offset the gains, and the tax owed would be taxes with harvesting. So this is when you actually use it. So without the harvesting, you're at 95,000 if you sell these without harvesting. So with the harvesting, now you combined 200,000 minus 130,000 plus, 200,000 minus 130,000 times 20% plus 150,000 minus 100,000 times 37%. So this will equal 14,000 plus 18,500, which equals $32,500. So in turn, with tax loss harvesting, this person saved $33,000 in taxes that they would have to pay. So instead of paying $95,500, this person will only pay $32,500. This is exactly why tax loss harvesting is very, very important. It may sound stupid to some people who do not understand what I'm saying. Like, why would you want to take a loss on your gains? Wouldn't it just destroy your profits? Yes, but Uncle Sam is going to collect every April. And take it from me, I had plenty of profits in crypto in 2021. I was not keeping track of what I was buying and selling. I was not experienced enough to know what tax loss harvesting or to watch that world was. So long story short, I had to pay about $5,000-$6,000 on about 20K profits of Dogecoin. And if I would have knew about these laws back then, if I would have kept track of my portfolio, I would have definitely started selling other stocks and investments that I have in order to avoid paying those taxes. You don't want to be caught up with the IRS paying interest in order to pay taxes you owe, or worse yet, trying to ditch it and filing and going to jail. So with that being said, I have to make a disclaimer. Listen to the Dreadheaded Trader with a grain of black salt. What I'm telling you, you cannot trust 100%. Know that I have your best interest and always keep it 100. I'm not a financial advisor. Call your tax man or your tax woman or your tax prepper, or speak to a banker or somebody who's professional at taxes. With that being said, let me continue. Now, I'm going to show you an example of a stock that I personally am using tax loss harvesting on at this very moment. It's actually an option of DraftKings. So over here, last month, I bought this contract on December 17th, 24, and I sold, I believe, right here on the 26th or the 27th of December. I sold on the 26th, day after Christmas. So if you looked at my last video, I was clearly explaining the 61-day grace period with the wash sale rule. So I have not bought anything 30 days prior to December 26th. The last buy that I had before the 17th was July 1st. I already did the math. 30 days after this sale is this Saturday, which will be January 25th. So when the market opens Monday, if I do not buy any DraftKings securities or anything similar until Monday, I will be eligible to use the wash sale rule if I buy DraftKings on Monday or after the 25th. So I had bought this contract for $150. I lost 135 because I sold at 15. So this year, 2025, when I file my taxes, I will be able to write off $135 as a short-term capital loss on DraftKings options. Pretty simple and plain. Here's another article. I'm not going to go through it, but this one's on optionstrading.org. You can look at this if you're an options trader like me. It'll specifically break down what you need to know about tax loss harvesting with options. What I showed you was another Investopedia article, and it was an example of somebody who had multiple mutual fund trades. So with that being said, this is Trading G's with G. Until next time, one love.